I want to start this video with a warning, not a hot take, not a viral clip, a real warning that could save you hundreds of thousands of dollars. I need to say something that might upset a lot of people in the tax world. And I say this as someone who works with high income earners every single day because I keep seeing the same mistake over and over again. High income earners, doctors, entrepreneurs, business owners, athletes, and executives sit down with a tax strategist or their CPA. They're told they're paying too much in taxes, which is usually true. Then they're told the solution is simple. Buy an Airbnb and use the short-term rental loophole. Do a cost seg study, take bonus depreciation, and offset your income. And on paper, that advice is correct. But in real life, it's destroying people financially. And the scariest part is this. They think they're winning while they're actually losing. I've now spoken with nearly every top tax strategist in the country, and almost all of them have admitted the same thing to me. Their clients did save hundreds of thousands, sometimes millions of dollars in taxes, but many of those same clients are now losing thousands of dollars every single month. And today I'm going to explain why, and more importantly, how to avoid making a mistake that looks smart on paper but destroys you in real life, because the loophole is real, the savings are real, but so are the losses if you do this wrong. Let me give you some context. Once again, I've spoken with nearly every top strategist in the country. The ones with massive social media followings, the ones on podcasts, the ones charging tens of thousands of dollars per year to work with them. I work directly with their clients, often after the damage has already been done. I operate hundreds of short-term rental properties. I see the full picture, not just the tax return, the P&L, the bookings, the cancellations, the guest complaints, the cleaners quitting, the maintenance issues, the cash flow. I'm not anti-tax strategy. I'm anti-incomplete advice. Here's the advice I hear constantly. You're making a lot of money. You should buy an Airbnb. Short-term rentals qualify as a business. You can use cost segregation, bonus depreciation that will offset your income. You can save hundreds of thousands of dollars in taxes. This is all true. But here is where the advice stops. There's no discussion about market selection, no underwriting, no revenue modeling, no expense analysis, no discussion about design, amenities, creating experiences, operations, management. It's just treated like a stock purchase. Buy the asset, get the deduction, move on. Real estate does not work like that. The client gets excited. They feel smart. They feel ahead of the system. They buy a property quickly, often in a market they don't understand. Sometimes because it was cheap, because it was close to home, sometimes because their realtor said it would do well. They do the cost segregation study. They take the bonus depreciation. They save $200,000, $300,000 sometimes or more in taxes. They celebrate, and then reality hits. Bookings are weak, rates are lower than expected, expenses are higher than expected. Then you got mortgage, insurance, utilities, cleaning, maintenance, management fees. And then before you know it, every month the property's negative. $1,000, $2,000, heck, even $5,000 a month. And here's the psychological trap. They already got the tax savings, so they justify the loss. They tell themselves it's fine. They say the property will stabilize. They say next season will be better. Meanwhile, the hole gets deeper. This is the sentence no one says out loud. Depreciation does not pay your mortgage. Depreciation does not pay your cleaner. It doesn't fix your HVAC. It doesn't respond to guest messages at midnight. Cash flow does. If the property cannot stand on its own, the tax benefit's irrelevant. You did not build wealth. You just delayed pain. This is not malicious. This is not attacking tax strategists or CPAs. It's just structural. Tax strategists are experts at the tax code. They're not experts at making sure this is a sound investment. They don't run properties. They don't manage teams. They don't compete on Airbnb listings. Sometimes they don't even own their own properties. So their mental model is incomplete. They optimize for tax efficiency, not asset performance. They assume performance will take care of itself. That assumption's wrong. The most dangerous myth is this: any Airbnb will work. That is not true. Some markets are oversaturated. Some locations don't have demand. Some properties photograph terribly. Some amenities don't move the needle. Short-term rentals are a hospitality business, not a tax shelter. If you would not want to stay there, if guests would not want to rave about it, It does not stand out. It will not perform. To succeed using the short-term rental loophole, two things must happen at the same time. Not sequentially, not eventually, simultaneously. First, the tax strategy must be executed correctly. Short-term rental status, material participation, cost segregation, bonus depreciation, and proper documentation. Mess this up and the IRS will destroy you. Second, the real estate must outperform. That means the property must be exceptional, not average, not fine, exceptional. Outperformance is not accidental. It's engineered. It starts with market selection, not markets you just like, markets with data, and then micro location, walkability, views, proximity to demand drivers, then property selection, bedroom count, layout, parking, noise restrictions, then design, not your taste, guest taste, the avatar taste. Is it families? Is it couples? Who are your guests? Then amenities. Amenities that create pricing power, not gimmicks. Things like pickleball courts, saunas, cold plunges, lazy rivers. Things that push the needle. Then management. Response times under 5 minutes. 5-star cleanliness. Proactive maintenance. This is work. That's why most people fail. When you buy primarily for taxes, you reverse the order. You optimize the deduction first, then hope the asset works. That's backwards. The asset must work first. The tax strategy should just amplify it. Tax savings on a bad deal is still a bad deal. When done correctly, here's what happens. You buy a high-performing property, it cash flows or breaks even conservatively, it grows through pricing power and reviews, then the tax strategy supercharges it. You reduce your tax bill, you keep your cash flow, you build equity, and you sleep at night. That's success. Here's my warning. If your tax strategist can't talk to you about their portfolio and them walking the walk, not just talking the talk, and talk to you about revenue projections, occupancy rates, operating expenses, market demand, guest experience, they should not be telling you to buy an Airbnb. They're giving you half the equation. Half the equation destroys wealth. The short-term rental loophole is real, but it's not simple and it's not passive. Be careful who you listen to, be careful chasing deductions, and be careful buying assets that you don't understand. Great tax strategy plus great real estate creates wealth. Anything else is gambling with a tax benefit. If this video saved you from a mistake, subscribe. If you know someone considering this, send it to them. And remember, the tax code is a tool, not a business plan. And thanks everyone for listening. I hope this video helps you understand some of the mistakes to not make and advice to not wholly listen to. I put a ton of time into this video, so if you liked it, please subscribe, like and comment on the video. Perhaps leave me a comment for anything I went through that you want me to go on a separate video about and go more in depth. My name is Elliott Caldwell, and I look forward to seeing you on my next video.